Tax computations. This is the part where you are supposed to correctly calculate tax due for the year of assessment, ended 31st March. Let's assume that Mrs. Kuno, a sole proprietor, owns a car rental business. She has provided the profit and loss statement for the year ended 31st March below. We will demonstrate how Mrs. Kuno will calculate income tax due for the year ended 31st March. Profit and loss statement for the year ended 31st March 2020. Gross income 300,000. Expenses: fuel 50,000. Salaries and wages 100,000. Repairs and maintenance 35,000. Depreciation 15,000. Total expenses 200,000. Profit, taxable income 100,000. In this example, we will demonstrate how Mrs. Kuno's tax liability for the year based on profit or taxable income 100,000 maludi obtained above. Firstly, it is important to take note of the income tax structure applicable for the year of assessment. An income tax structure indicates how tax liabilities of resident individuals, being sole traders, employees, and pensioners for pay as you earn are calculated by applying the correct marginal tax rates on an income for an individual for the year of assessment. For example, according to 2019-2020 income tax structure, where chargeable income A is between 1 loti and 61,080 maloti, the lower marginal tax rate of 20% will be applied and tax will be equal to 20% of the amount. B exceeds 61,080 maloti, then the excess over 61,080 maloti shall be taxable at a higher marginal rate of 30%. And C, the non-refundable tax credit of 8,430 maloti will be deducted and is applicable to each resident individual. First step, the lower marginal rate of 20% will be applied up to threshold of 61,080 maloti. 61,080 maloti by 20% equals 12,216 maloti. Second step, calculate the excess or balance over 61,080 maloti by deducting 61,080 maloti from the total profit. Taxable income 100,000 maloti minus 61,080 maloti is 38,920 maloti. Third step, apply the higher marginal tax rate of 30% on the balance or excess. 38,920 by 30% equals 11,606 maloti. Fourth step, calculate the total tax before credits by adding the answer obtained on the second and third steps. 12,216 maloti plus 11,676 maloti equals 23,892 maloti. Fifth step, deduct a non-refundable tax credit of 8,430 maloti from total tax obtained in step 4 to get tax due. Note, a non-refundable tax credit reduces total tax payable 23,892 maloti minus 8,430 maloti equals 15,462 maloti. Therefore, out of 100,000 maloti profit, a client will pay the sum of 15,462 maloti.